Hello everyone and welcome back to our channel. In the previous episode, we argued that the AI race is shifting from competition in technology and chips to competition in the ability to mobilize capital. Just a few days later, that thesis has already moved one step further. The latest reports show that Nvidia, which had been discussing roughly $250 billion in financing guarantees for OpenAI's 10-gigawatt Ohio data center project, now plans to provide an initial backstop of less than $120 billion, covering only the first phase of roughly 5 gigawatts. The full project may still proceed, but the second phase no longer has the same degree of credit support. The most important point is that the market is beginning to ask a question it previously paid far less attention to. If AI infrastructure requires hundreds of billions of dollars, who ultimately bears the risk of long-term leases, debt, equipment depreciation, and underutilized capacity? The next stage will be determined by the cost of capital, customer credit quality, and project cash flow. In the previous episode, we described a complete chain. Blackstone mobilizes capital, Nvidia converts that capital into computing platforms, Micron supplies HBM, and Microsoft monetizes the capacity through Azure and enterprise customers. We now need to insert another layer into the middle of that chain: credit screening. The updated transmission chain is as follows. Asset managers raise capital, banks and private credit funds evaluate leases and collateral, Nvidia or other suppliers decide how much risk to backstop. Only after financing approval does the project convert into orders for GPUs, HBM, power and cooling, and platforms such as Microsoft ultimately monetize the capacity. This means the AI supply chain is not losing its growth story as a whole, but dispersion will become much more pronounced. Companies with strong cash flow, customers, and a closed monetization loop may command a premium, while companies dependent on vendor guarantees, GPU collateral, and continuous refinancing may face a credit discount. Let's start with Nvidia. NVDA closed Friday at around $225.16, while the reduced guarantee was reported after the market closed, meaning normal price discovery has not yet taken place. At the next open, the market is most likely to focus on uncertainty surrounding the second 5-gigawatt phase and the circular financing concern that Nvidia may support customers that then use the financing to purchase Nvidia chips. However, this is not a one-sided negative. Reducing the proposed guarantee from roughly $250 billion to less than $120 billion also lowers Nvidia's contingent liabilities and concentration risk to a single customer. If the first phase still includes non-cancelable GPU purchase commitments, Nvidia could achieve a better outcome, preserving a large portion of the orders while transferring part of the credit risk to third-party capital. Technically, the first level to watch is around $224.50. A break below that level could lead to a retest of $217.50. The medium-term uptrend would not be seriously damaged unless the stock also breaks below the $208 structural level identified in the previous episode. Conversely, a quick recovery above $227.50, followed by another challenge of $236, would suggest that investors view the change primarily as risk reduction rather than weakening demand. Therefore, our Nvidia strategy should shift from simply buying every pullback to first confirming how the market interprets the agreement. Until a formal contract is disclosed, chasing an opening gap would be premature. The stronger add signal would be confirmation of first phase orders, together with a recovery into, and eventually above, the $227.50 to $236 zone. Next, Microsoft. MSFT closed Friday at approximately $495.40. Nvidia's reduced guarantee does not create a direct order shock for Microsoft. Instead, it reinforces our previous thesis. As AI projects become increasingly dependent on credit quality and long-duration cash flow, companies such as Microsoft, Alphabet, Meta, and Amazon, which can finance investment through their own cash generation, gain a stronger competitive advantage. Microsoft's advantage is not merely the size of its balance sheet. It has a complete monetization loop. Capital expenditure builds Azure capacity. Enterprise customers pay for cloud services and Copilot. The resulting cash flow funds the next round of infrastructure. By contrast, unprofitable model developers require continuous financing, making their expansion directly sensitive to the cost of capital. Technically, the $485 to $489 region remains an important pullback support zone, while $475 remains the medium-term invalidation level. A high-volume move above $505 would keep the original first target of $520 in play. Compared with the previous episode, Microsoft now looks more suitable as a relatively defensive AI holding within a credit differentiation trade, rather than the highest beta vehicle. Micron closed Friday at $971.66, already inside the $960 to $980 first target zone from our previous episode. This confirms our earlier view on HBM earnings leverage and capital rotation into memory stocks, but it also means that the current risk-reward profile is entirely different from the one we had at the previous entry levels. Nvidia's reduced guarantee does not immediately reduce first-phase HBM demand, but it does lower the certainty of orders associated with the second phase. For Micron, the main short-term risk is not that orders suddenly disappear, it is that the share price has already discounted substantial growth, making profit-taking more likely if AI capital expenditure becomes more phased. The first short-term support is around $956, followed by the previous breakout zone at $925 to $940. A break below $956 without a quick recovery would indicate that investors are beginning to price delayed order conversion. If the stock holds this region and clears Friday's high near $987, the trend could still extend toward the $1,050 area. Micron is therefore no longer in an attractive chase zone. Existing positions are better managed by raising protective levels and taking profits in stages. New positions should wait for a confirmed pullback, rather than treating a target that has already been reached as a fresh entry point. Finally, Blackstone. BX closed Friday at $143.93, moving back below the $146 breakout level from our previous episode. This clearly weakens the earlier short-term breakout signal, although the $142 to $144 support zone remains intact for now. The fundamental thesis also needs to be redefined. We previously treated Blackstone as a direct beneficiary of AI capital expansion because it could raise funds and earn management fees. We must now add the other side of the equation. As Nvidia reduces its guarantee, private capital may earn wider spreads and gain more transaction opportunities, but it must also absorb OpenAI credit risk, GPU residual value risk, lease risk, and utilization risk. Therefore, the bullish condition for Blackstone is no longer simply that AI financing grows. The financing must remain attractive after adjusting for credit risk. If BX holds $142 to $144 and reclaims $146, the market is signaling confidence in its fee income and underwriting discipline. A break below $138 would invalidate the medium-term breakout structure from the previous episode. That is, Vertiv, VRT, rose to $293.84 on Friday, leaving both valuation and expectations elevated. The first 5 gigawatt phase still represents substantial demand for cooling and power systems, but a delayed second phase would slow the conversion of future orders. The $285 to $286 area is short-term support, while $295.50 is the key breakout level for judging whether the market is willing to look through the financing risk. The two most important signals for next week. First, whether OpenAI signs a binding long-term lease covering the full 10 gigawatt capacity. If only the first phase is confirmed, the second phase can no longer be valued as a committed order. Second, the detailed terms of Nvidia's sub-$120 billion guarantee. Investors need to determine whether this is simply standard project phasing or a substantive reduction in Nvidia's exposure to OpenAI credit. For traders, if Nvidia remains resilient, Microsoft strengthens, and CoreWeave, together with leveraged AI infrastructure stocks, weakens, it would signal a rotation from the broad AI growth trade toward an AI credit quality trade. That's all for today. If you found this AI credit screening framework useful, please like, share, and subscribe. See you next time.